Hello, hello, and welcome to the second quarter market outlook and review. My name is Austin Fitch, and I am joined here today by our CIO, Scott Ladner, here at Horizon Investments. We're really excited for you joining us today, taking the time out of your busy work week to go through kind of what has happened, but also looking out into what we think could happen as we head into the back half of 2026. For those of you that are new to this call, don't hesitate to ask questions. You have that feature as part of the webinar functionality. We welcome those questions. We'll try to get to as many of them as possible during the call. We'll hit some of them as we wrap up the call at the end of today. And then if we don't get to them, I would say we will make sure to reach out. Don't hesitate to reach out to us as well to continue the conversation. Would love to use this as a jumping off point for any questions that you have or that you're getting from clients when it comes to markets and when it comes to the economy and how things are working. So Scott, really excited to get into the conversation, really hitting on some high notes here from an agenda topic, and we'll get into the weeds here in a minute. But we're going to start with the consumer because that's something that really at the end of the day is a driving force for the economy. And that being said, let's start kind of where we've left off in the past. Let's talk about the AI concept or the topic in relation to the consumer, because that's at the forefront of seemingly everybody's minds at this point.
Yeah. Hey, Austin, and hey, everybody. Look, this is you're gonna hear a lot about AI again this quarter. We've been talking about this not almost every quarter for over 3 years now. This is the most important thing happening in the economy, technology wise, and therefore in markets as well. I think hopefully we've got some differentiated views on some of this stuff that will shed some light on maybe some of the fallacies that you've heard out of kind of where some of the perils of AI are. I'm not here to tell you that everything is going to be always perfect. There are certainly some things we're going to talk about on the downside of things for AI, but this is the most consequential thing to happen in my lifetime, and certainly in markets for a very long time. So we're gonna dive into it, and one of the things that we do here a lot, Austin, like about almost every speech I give, somebody's asking about basically a question like this, AI is going to take all the jobs, this is just like kind of a misunderstanding, I think, and kind of a fear-based response from history. I mean, look, we can look at history and we can take some lessons from the idea that when something technology-wise gets cheaper, or make something cheaper, you use more of it. We've seen this. Many of you have heard me talk about the example of steam power back in the 1800s. As people thought that coal was going to go away, or coal prices were going to decline because steam power would use coal much more efficiently, and what ended up happening is when it became much more efficient and much more productive to use something like that, you end up using a lot more of it, and so coal actually demand went through the roof through this, and this idea was sort of posited by this guy named Jevons, and you're going to hear a lot about Jevons paradoxes, and this is I just want to make sure that our our listeners and viewers and clients understand that this is what is happening with AI. That you have to understand this concept of when something becomes cheaper, you use more of it. And so the idea that AI is going to take all the jobs, frankly, we think is just completely unfounded, and really misunderstands history and really how technology works through an economy.
So Scott, you brought up kind of what we've seen. I think this is actually a great picture of exactly that when it comes to job postings in those industries that are exposed to AI. So maybe kind of help us unpack what we're looking at.
Yeah, look, I mean, this is ground zero, right? I mean, it's like software coding. Anybody can code now. My 11-year-old can code now, if she were so inclined. And look, I can code a little bit. I code through brute force is terrible. Like people that are actual coders look at my stuff and just laugh at me. And so I can use the stuff to become a better coder and to try more things and whatnot. And so everybody thought that software, why would you ever be a software engineer? Why would you ever hire another software person if everybody can code now with AI? And the reason is pretty simple. I'm a knucklehead with coding. I can become slightly less of a knucklehead with coding now with using AI. But somebody that actually knows what they're doing with this stuff can increase their productivity by orders of magnitude. So if somebody could produce 100 lines of code in a day, now they can produce 700, 800, 900 lines of code in a day. If the software engineers that actually know what they're doing with this stuff. So people are using this tool to make this job much more valuable. And so you actually want more of the software developers now because they can do much more for your company in a much more efficient way, make you a lot more money. And so what we're seeing here is just the job market for software coders, developers has started to skyrocket. And because people realize that now this thing has become cheaper, these people are much more efficient. They are much more productive. They're kind of the marginal cost sort of argument from microeconomics that we all learned is playing through in this. And so we're seeing that a boom in software software developer engineering. And this is just like this is just sort of ground zero. This is like the most obvious example, but but there's certainly others that we're going to talk about here in a sec.
Well, you mentioned that, and Scott, I would highlight, like, we've seen this before, right? Like, we saw it in the 90s when Excel came out. I think there was a fear that accountants or bookkeepers would become extinct, right? And that's actually the opposite of what happened. If you actually look at the number of jobs in those areas of the marketplace after the release of Excel and specifically kind of the automation of some of those tasks that for so long folks thought were, only accountants and bookkeepers could do. And now you had a tool that allowed them to become that much more efficient, right?
Yeah, and it's the same story, and and the next slide is going to talk to this as well, Austin. Like where we're saying, like people are actually being able to do studies now. We're getting enough data now in the economy and in the real world where we are seeing this play through in the existing job market, right, Austin?
Yep. No, I think you're spot on, Scott. And I think one question that we get a lot is, okay, that's great for the job market as a whole, but it's got to be taking the entry level jobs, right? It's got to be getting rid of those jobs that you would think are maybe a little bit more automatable. And I think what's super interesting to me, Scott, is we look at the chart on the right-hand side of this screen, and you're actually seeing entry level jobs that are tied to AI adoption. You're actually seeing headcount increase even faster than you're seeing the entire job market for those jobs tied to AI adoption, right, Scott?
Yeah, and look, and this is so if for those advisors that have college age kids, and my oldest is going into college next year, like this doesn't mean that that you're not going to have a job, but it does mean that you need to learn how to use AI. So like just like if you couldn't use Excel in the mid '90s, you were a dinosaur. Like there's no reason to hire somebody that can't use the right tools to do the job well. And so, yes, like it is required now that you figure out how to use the stuff and become an expert in it. But that is the new entry level job. And this is we're just seeing this play. We're seeing the Jevons paradox thing play through in the existing job market, but that's not even the most important aspect of this, I don't think, on the employment side.
Well, one thing I would say, Scott, and we're not going to spend a lot of time here, but like even for those jobs where you're not adopting AI, I mean, you're not seeing a negative impact yet, which would tell you that the labor market is still in a pretty decent spot, right?
Yeah, look, this is the bottom of the first. I mean, like we're just figuring out how to use this stuff. The agentic workforce, the agentic stuff is really extremely new, obviously. People are, generally using ChatGPT and Claude and everything as basically an enhanced search engine at this point, but that is not going to be the final or best use case for this technology. Like it is going to sort of sweep across everything. And so like, I'm glad that we're finally getting some data on some of this stuff. It is making the sort of the theory come through in actual practice. But it is really, really early stages on this.
Yep. Scott, you mentioned use case of kind of AI, and I think one area that's super interesting is if you start to look at some of the business formation stats, and we got a couple slides, we'll talk about this, but like you really start to see kind of the needle being moved post kind of AI implementation and adoption over the last few years.
Yeah, look, this is the most important part about AI in the labor market. Yeah, it is going to increase demand for jobs that can use the technology in ways that's efficient, makes them better at their work, all this kind of fun stuff. But the entrepreneurship, sort of the barrier to entry to start a company today is the lowest it has ever been in the history of the entire world. It is just easier to start a company today than it ever has been. So take an idea and see through to fruition. So like the title on this slide says it all, and it is again the most important aspect of the AI thing that I think is completely underappreciated by the market and by economists still so far, is that I'm pretty sure the next huge company's already been started. That should be an incredibly exciting thing. Now, look, I obviously can't prove this yet, but there are companies that have already been started. There are companies that are going to be started in the next year or two. that are going to employ hundreds of thousands of people doing really, really cool stuff that we just don't even know about yet. And that is the most exciting part of this, is that the lowering of the barriers to entry to start a company. That means we're going to try more stuff. We're going to have more innovation. We're going to have more sort of dynamicism throughout the economy. It's going to be focused in the United States mostly because we are the sort of the innovation engine of the world. But this is the most important aspect of the AI. If you're thinking about the labor market, if you're not thinking about new company creation, sort of business formation, new initiatives, you are completely missing the boat on the AI impact for the labor market and the economy.
Yep. No, I think you're spot on, Scott. If we shift gears a little bit, we stay focused on the consumer, but start to talk about, okay, so where do they sit from a consumer health standpoint? We've hit on that many times in the last couple quarters. I think we're at a point where, I mean, the consumer's still spending. Like, let's take a look at, how are they spending? Where is that coming from, right?
Yeah, and look, you can see we track this metric called total payrolls. When one of like one of our folks came up with this, Zach Hill came up with this idea, and the idea is to say, listen, let's take the number of hours that people are working times how much they're getting paid times how many workers there are, and that'll sort of give you like a kind of a rough estimate for like what's the national income, like how much are people getting paid to work. And that is generally the pool from which they spend money. Obviously, you can spend money from that, or you can spend money out of savings. But that's not the only places you can spend money. You can spend money out of accumulated wealth as well. Generally, in this country, that has come from the housing market. People have used their houses to finance purchases, to sort of move up economic sort of rungs through time. But that's not the only engine. The stock market and sort of the investing market, broadly speaking, is another really important driver, and an increasingly important driver for spending, and especially in the United States.
Yeah. No, and Scott, that's a great point. We've got a couple charts here that really start to unpack that. Like, if you look at the chart on the left-hand side, right, you can look at how household net worth really has grown over the last couple decades, right? And especially if we zoom in on the last couple years, maybe throw COVID out of the mix there with the spike that we saw, but back to where you're seeing that growth, like 8 times where it was, if you look at disposable income growing over time. And I think that's extremely important. But to your point, like really starting to understand where that's coming from. And like you said, historically, a lot of times that's tied to real estate. Now, though, a lot of that wealth effect is actually tied to the stock market. That's not necessarily a bad thing, but it does start to introduce maybe some new risks or some things for us to at least be cognizant of as we start to think about some of the spending patterns, and for some folks, probably even the how they feel about their personal, financial health situation as you think about what the market does, right?
Yeah, look, there are two sides to this coin. This is undoubtedly a positive development for the overall economy, for consumer spending, for consumer health, all that kind of stuff. Having household net worth where 800% of disposable income is absolutely astounding, and it's a really, really strong signal, and is a large pool of money from which to spend, and from which to sort of conduct economic sort of activities. But it does also make the economy more tied to the stock market in a way that it hasn't been really, since or it's just, I guess it has been in the past, but it is increasingly tied to the stock market. So one thing that is there's a worrisome part about this is, if you do have a big stock market swoon, that is going to hit the economy in a way that is more severe than it has been in the past. And so that's something that we got to keep in the back of our heads. That the economy and the stock market, everybody's like saying, the market's not the economy, or market's not the stock market, whatever. You know what I'm saying? Like the economy's not the market, all that kind of fun stuff. That's saying, but and it's true, but it's increasingly less true. And so I think we do need to appreciate and sort of keep in the back of our heads the idea that if we do get a big stock market correction, by the way, we're not calling for one anytime soon because of all the stuff we're going to talk about here. But there is that risk out there that if you do get a big market correction, that is going to hit household net worth. It is going to hit the economy, and it's going to hit spending in a way that the economists aren't going to be necessarily equipped to deal with, because we don't have a very good sort of math model to figure out this stuff because of just the increased reliance of for spending on sort of equity market returns in people's portfolios.
Yep. No, that's a good point, Scott, and something that definitely makes sense for us to kind of keep in the back of your minds, like you said. To your point, we're not calling for a recession. We're not calling for a significant market pullback by any stretch, but something to at least have there in the event that we start to see cracks at some point in the future. All right, so shifting over to the economy, Scott, we did this call 3 months ago. I think the only thing we talked about seemed like was the war with Iran, and sure enough, you blink and it's over and everything's back to normal. Is that kind of how we should think about it?
Yeah, she gone. Like this is done. As far as the market's concerned, it's been done for a month or two. But I just wanted to highlight here, like here's some commodities, and obviously this was a commodity centric sort of conflict with respect to how it's going to really play into the broader economy and into markets. And so just listed, you got wheat, corn, oil, urea, which I had to learn about through this conflict. It's like fertilizer types of stuff, and just a broad commodity index. So let's just take all the commodities and sort of lump them together. And all it is just normalize this to, all these numbers to 100 on the day before the war started, and just walk it through time, and you can read the chart. Everything's basically back to or below their prices from when the war broke out. So from an economic impact standpoint, we are still going to see some of the effects from these past rises in the economic data for the next couple of months because of backward looking nature of economic data. But from a forward looking standpoint, which is all the market does really care about, this thing's done. And again, it can start back up. I'm not a geopolitical guy. Like, this is not a prognostication about what Trump or Iran or anybody else is going to do. But as far as the market's concerned, this thing is done.
Scott, you talked about kind of the backward looking nature of some stats versus maybe the forward looking nature of markets more generally. I think this is a chart that does a pretty good job of kind of highlighting the differences between PCE, which tends to be just more backward looking by definition, and then something that we've started following over the last couple of years, a measure of inflation by a company called Trueflation, where they're literally kind of gauging inflation on a daily basis. And I think here you start to see that divergence just over the last couple of months that speaks exactly to what you just talked about, right?
Yeah, and this is important, Austin, because because of the leading nature of Trueflation with respect to like what we're going to see out of the out of PCE, and PCE is core PCE is the thing the Fed cares about the most. There's a lot of different ways you can cut the inflation, kind of cut the inflation data up. But look, I could show you 12 of these charts. They're all going to tell you the same thing. And like, no matter how you cut up the inflation thing, all the Trueflation data is saying like we should be heading lower with respect to inflation. All of the official data are saying we're seeing a renewed sort of like mini surge in inflation. Yeah, that's the yellow line. But just understand that there's a leading nature of this Trueflation. So that, this should be seen as basically a downward pull. We're going to see a downward pull on core PCE, coming in the next several months, because this divergence is starting to happen and because of the leading nature of the Trueflation data set.
Well, and Scott, if you look at kind of how the market's pricing it, right? If you look at kind of what are known as inflation swaps, you can look at it over the next 12 months, over the next essentially 24 months, and essentially over the next 36 months. That's kind of what we're doing on this chart. And I know we've shown this chart or some version of it in the past. 3 months ago, I think the expectations for a 12-month inflation number was pushing into the mid threes, right? So well above the 2.5 where we had been coming into the end of 2025. And now you see it, that dark blue line. What are expectations 12 months from now? Well, now we're actually back even maybe below where we were coming into the beginning of this war in late February, early March. I think what's super interesting though, Scott, and I think we touched on this maybe even last quarter, you really didn't see the longer term inflation expectations budge at all. So the lighter blue line, the yellow line on this chart, neither of them really moved at all during the conflict itself, which would tell us that there weren't even really expectations for long term inflation shocks. It was more of that short term bump that, to your point, the market's already starting to correct on.
Yeah, and look, and for those those people that are worried about Fed credibility with respect to fighting inflation, this chart should be very comforting to you. I mean, like this is we're not even talking about like 5 year inflation expectation, any of the really kind of longer term inflation expectation stuff. We're talking about like 2 years, 3 years out. And, and obviously, the next 1 year stuff is utterly collapsing right now, which as it should, based on the commodity price movements and based on some of the truflation sorts of things. But this is also a chart saying like yeah, the market really never doubted Fed credibility with respect to fighting inflation in this most recent episode. You could have made that argument in 22 that the market was starting to get a little jittery about the Fed's ability or sort of kind of like willingness, I guess, to really kind of combat what was then a pretty scary inflation path. But that was nothing. That was never the case through this war. I mean, like the market never really sort of doubted that this was going to be a temporary sort of thing, and or the Fed had the willingness and the tools in order to combat it at the end of the day.
Yep. No, that's a great point. All right. So if we shift gears a little bit and bring back the AI conversation, Scott, this starts to tie into some of the efficiency stuff that we've been talking about for some time. And I know we'll talk a lot more about that. But you touched on some of the business startups and adoption of AI. I think this chart is pretty telling as you start to see like we've crossed the 50% threshold when it comes to overall adoption of companies using AI. Now you can see kind of with some of the individual lines, whether it's OpenAI, Anthropic, Google, you choose your use case, you choose your version that you're using and the company that you've selected when it comes to your AI model. But Scott, we have crossed that 50% threshold. And I think if we maybe even kind of dig a little bit deeper, really starting to unpack, like it's not just the companies that think of it as have the biggest war chest, right? You're starting to see some of those small and medium-sized companies really kind of enter the fray, which was super interesting from a growth standpoint, right? Because those are the companies that they're able to leverage AI, then really you would expect things to take off from an economic standpoint.
Yeah, and look, and just a quick point about the prior chart. Also is like I don't care who wins this race. I don't care if it's OpenAI or Google or Grok or who cares? Like
Yeah.
matters 0.0% to me. I want somebody to win. I mean like it's sort of like I want to bet on the Kentucky Derby. I want to bet on all the horses, like on one of them to win. Like right, I don't care which one it is. I want one of them to win, and I'm pretty sure one of them will. And so like that, that is sort of the race we're running, and the fact that we're above 50% now is good. It'll start to really kind of take off from there. But to this chart, I mean, yeah, the fact that we're seeing small and medium-sized businesses, like this was the one that was actually a little bit concerning to me, like as recent as a couple months ago. It's like if we don't get the small and the medium-sized businesses really sort of taken off and using this stuff, it's going to really slow the adoption, really slow the diffusion of the technology throughout the economy, because there are so many, there's just so many more small and medium-sized businesses than there are, companies in the S&P 500, obviously. And so like we seeing this really start to rocket ship for the small and medium-sized guys, and we're going to dive into this, this in a little bit, take a little bit different angle on it here in a couple of slides as to why this is also important and sort of obvious. But the fact that we are starting to see this is a really, really good sign for the sort of the diffusion of the technology throughout the economy, and therefore it's sort of the productivity enhancing effects that will end up taking place here in the next few years.
Yeah. And Scott, at one point you brought up that we don't care who wins. I think an interesting anecdote. So for those of you that have talked to or know our CTO, Calvin DeBoer, he has his team on a weekly basis trying out different versions of AI tools, right? And I think what's super interesting in talking with him is, he says 1 week, maybe one of them's the best at doing XYZ task, and a month later, somebody's jumped them, right? And seeing that growth, I think, Scott, to your point, is like they're that competitive marketplace is just pushing everybody forward, which is super helpful.
Yep, we love to see it. Don't care who wins, just want a winner.
So if you think about kind of that AI adoption, and this, Scott, goes back to some of that business formation that we talked about earlier, I think this is super interesting. Like the startups themselves are coming from more solo founders than they are kind of the multi or the team-based startups as you start to look at who are founding these new companies, which we think is probably a good sign, right?
Yeah, look, I mean, 8,000 solo found companies in the first quarter. We'll get these data here again in a few weeks for the second quarter. I'd be shocked if it tells you anything different. This we are undergoing a solo founding or small, very small team, company founding boom in the United States, and it will probably be globally, but I know it's going to happen in the United States. And that is just like it should be incredibly exciting because like we just need some of these to work. We need some of these to win. And just as ingenious as American entrepreneurs generally are, I'll bet on that one all day long.
Well, and that goes back to Scott, the comment you made earlier. Google very easily could have been a solo founder out of a basement or a bedroom as part of this 8,000, right?
Yeah, and I think it's again like I can't prove it, but I wouldn't bet against it.
Yep. All right. So, Scott, we've talked a lot in terms of the optimism around AI. But I think we said at the beginning, like it's not all rainbows and butterflies. There is definitely some risk associated with it. So let's maybe unpack what we think could be a potential risk when it comes to kind of the AI conversation and the adoption and what we're seeing there, or maybe what we haven't seen yet, but what we could potentially see.
Yeah, look, this is like this should be a little bit concerning. I mean, it's a little bit concerning to me, and I'll kind of walk you through the logic as to why. AI is becoming but less popular with the U.S. population. I mean, people are they don't really understand it. It sounds a little bit scary. It sounds like too futuristic. It's going to take my job. Like everybody's worried about that, and so it's becoming a little bit of a whipping post for the political class. And and if broad swaths of population end up like really sort of turning sour on AI, and like it is going to be ripe for regulation. It'll be an easy thing for the politicians to attack. And if they do, then you enter into this kind of weird place where you might end up with some like a regulatory regime that is not terribly helpful for the AI sort of companies, and it's at least the producers of AI stuff. And that's not a great place to be because one, it's going to slow down innovation, but two, also from an investment standpoint, look, I mean, tech companies don't trade like utilities. If AI ends up being a highly regulated thing because the public ends up viewing it as dangerous and politicians want to govern it and regulate it with an iron fist, then you end up with less innovation. You end up with with a place where you probably don't want to value these companies as highly as you would have otherwise, because again, like I said a second ago, like tech trades different than utilities. Utilities are a highly regulated thing. But if kind of AI produced intelligence or intelligence becomes viewed as a public good or as a commodity kind of thing, then the purveyors, so the producers of that public good, the producers of that are sort of like akin to the producers of electricity or water, other things that are viewed as public goods and sort of like a population's by right. And if intelligence ends up being viewed as the population's by right, then it's going to come under a regulatory regime that might not be very helpful for the investment case. It's still great for the economy. Don't get me wrong. But for those companies that are the producers of AI stuff, if they come under that sort of regulatory regime, we're going to have to think closely about how we value them. Obviously we're not there yet, but this is on my mind right now.
Well, Scott, I think that's important. Like you said, we're not there yet, but especially, and we don't have any slides on midterm elections. We know obviously they're coming as we get into the fall, but I think this is something that we'll pay close attention to as you start to hear more candidates speak out, because if that's something that really somebody's pushing forward, Scott, to your point, like it absolutely could have an impact as we head into the back half of this year, but probably more importantly, next year and the years beyond.
Yeah, and then look, the positives out of this, like at this point, so much greatly outweigh the negatives. That is it's not even funny. But again, we don't want to be blind to the risks that are out there. Like this is a real risk. And so we don't want to be blind to it. We're assessing it. We'll sort of track it through time, and we're developing a sort of an intellectual framework around which to understand how AI companies might be valued if they do enter a utility-like regulatory regime.
Well, and the reason it's important, and Scott, you kind of alluded to this, right, is the economy is becoming more and more focused on AI as we move forward into 2026, as evidenced by this chart.
Yeah, look, the AI investment, there's the blue parts of these lines, and that is in terms of like contribution to GDP growth in the United States. is increasingly like really important, and like you got to have it. Without the AI investment, this chart would look very different, and the economy, frankly, would look very different. But that counterpositive is sort of a silly thing to do. Like it exists. So we're not. I don't want to like play the game where like what does the world look like if this thing doesn't exist, because it exists. So it's pointless to play that game. But it does this does sort of tie AI investment and sort of how AI does to the broad economy. Like we got to get this right. Like we got to get it right. I'm pretty sure we will. But in terms of like the importance of the economy and therefore markets, like this needs to go well. And it's not, don't hear me saying that this is going to be a straight line. Don't hear me saying we're not going to get sort of bubblish behavior and different sort of pockets of this investment theme, because we certainly are. That's the nature of the beast. But we have to get it right at the end of the day. And look, it's America. I'm going to bet on it's like it'll be fine. But we do need to understand sort of the concentration risks and sort of the tight like the sort of the correlation between AI and the economy is only going up right now.
Yep, no, that's a good point. Scott, we'll end with kind of one last slide focused on kind of the AI conversation. I think this one's super interesting. This just looks at kind of the global population, right? And basically kind of highlights the fact that as we sit today, less than 20% of the global population is even using AI in any way, shape, or form. So those are the green, yellow, and red kind of squares down there at the bottom, right? So you think of it as each dot represents a little over 3 million people. There are really only about 3 million heavy users of AI as it sits today, as evidenced by the one red square. Then you have kind of think of it as medium tier users of AI, right? The folks that are willing to pay for a subscription of some sort, right? That's the yellow boxes that you see down there on the bottom. And then the green is those are folks that are using the free version of pick your AI, software tool. But I think what's super interesting is if you start to think about, okay, what does this look like, 5 years from now, 10 years from now? Scott, to your point, and I think you kind of said it earlier, like we'd be willing to bet that more people are using it. There's more adoption as we get out into the future than less, meaning that, this AI theme is really in the early innings. Now, do we know exactly what it's going to look like? Do we know exactly where it's going to go? By no means, but as evidenced by this chart, there's a lot of room to run, right?
Yeah, look, I mean, like this thing's never going to look like an upside down traffic light. It's not going to fill all the way in, but it's going to get more full. And the point of this isn't to be precise about any of this stuff. It's just to get sort of try to give a visual and understand like there's a lot of runway still to go on adoption for this technology.
Yep. All right, we'll shift gears a little bit. We've got a couple slides on as we talk about the U.S. economy. We often get the question, well, is the U.S. going to continue to be kind of the safe haven currency? Is the dollar going to be, what it is today in the future? Is America going to continue to be kind of the safe haven for the global economy? And Scott, I think this slide and the next couple, hopefully we'll do a decent job kind of unpacking how we're thinking about that question, because at the end of the day, I think that the short answer is yes, but there's some nuance to that conversation.
Yeah, look, like what else are you going to do? This conversation about the demise of the dollar or the U.S. debt becoming like unsustainable and this massive risk. Like, look, I'm sure there's a number. I'm positive there's a number of debt in the United States that would cause a problem. I'm also positive that we're nowhere close to that right now, and as evidenced by some of these things we're going to show. But like, people have to we got to get out of the habit of like looking at the United States in isolation. And you're looking at it sort of like in a time series format, like how is it doing versus itself, or how is it doing versus its past history? That's not the right way to look at this stuff. The right way to look at this stuff is in the cross section. If you're a global investor, you got to put a dollar somewhere. Like you can't choose to not invest. You have to choose somewhere. And that could be that can be a cryptocurrency, that can be a Bitcoin or whatever kind of thing. That can be a Chinese yuan, that can be a euro, that can be a yen, that can be a dollar, whatever. It can be, but it's got to be one of them. You got to choose one of them. So like, what are you going to choose right now? Like, honestly, these charts, like, yeah, the U.S. is like, it's in a little worse shape financially and fiscally than it has been in the past. But look at it compared to the rest of like all the other like rest of the developed world plus China. It is kind of middle of the packy. It's okay. Like China's getting materially worse. I'd be really worried if I was in China right now. But in terms of like the U.S. like fiscal sustainability or any of this. It is not coming through in these data right now. And again, don't hear me saying like this is impossible to have this be a problem. I'm saying it's impossible for this to be a problem in the second half of 2026, and probably for really, frankly, the foreseeable future. But from an investment standpoint, this is just a non-story, because the United States still has the best rule of law, still the best innovation. We are the hub of technology, the hub of innovation, the hub of sort of founders. Like everything good from the world economy ends up coming from the United States to start with. Other people might latch on from an innovation standpoint, but the growth is centered here. And that is keeping the dollar strong. The dollar's up 40% since the great financial crisis. It wouldn't be doing that if people were worried about the debt sustainability. I promise you.
No, I think that's a great point. And Scott, you kind of mentioned it earlier, right? Like you're continuing to see demand, whether it's treasuries, whether it's corporates, whether it's equity securities. Like folks are buying U.S. stuff. We have not experienced the period where they are, turning their back on U.S. markets. Like you're seeing that broadly across all different asset classes continue to grow and continue to expand. That is something that if that were to change, maybe the conversation internally would start to change a little bit, but we're just not seeing it, right?
Look, if you start seeing outflows, from like if you see like the buyer strike. I mean, look, we got a little mini buyer strike after Liberation Day. Foreigners really kind of fled. They sort of fled U.S. assets for a couple of weeks, and then they came back because again, like what else are you gonna choose? And so if you start seeing like flows out of the United States, like from a financial asset standpoint, from an investment standpoint, like that's a signal that people are voting with their feet. And they're moving money out of the United States because they think there are better alternatives other places. None of these charts show you that. All of these charts show you that people will continue to hoard U.S. financial assets of any kind, and that is an important signal because look, and people aren't going to do make a trade or make an investment that they think is going to lose money. Capital seeks its highest risk-adjusted return, and that capital is still flowing in the United States by and large. Like until or unless you start seeing some of these charts, do an upside down smiley face, it is that's a signal the U.S. is still a pretty strong financial position for global investors to invest in, and that is where the rubber meets the road ultimately.
So Scott, you mentioned strong financial position, which maybe leads to the last question in this section that we oftentimes get is, hey, the U.S. By no means is in a strong financial position. They're never going to be able to pay off their debt. Like we're going to be doomed eventually. Help us unpack that question and then kind of how we would think about responding to it, because I think it's a different response than you and I would personally have to a problem when it comes to paying off debt, because the country is very different than a household.
Yep, that sentence out, Austin, is the most important thing to answer any of these questions, and to understand, frankly, like you cannot think about the United States finances like a household. Period. They are totally different things. They have to be analyzed with totally different lenses. They have to be thought about in completely different ways. Like the U.S. will never pay off its debt. And it shouldn't, frankly. Like those of you that were around in the late '90s, remember when we when we had the budget surplus under Clinton towards the end, and we stopped issuing 30-year bonds. The Treasury market had a little bit of a conniption fit. Like it was kind of a mess for those that were trading back then. Because you didn't like what do you benchmark a long interest rate to? The 30 years gone, and that created all sorts of problems. So like if the U.S. were to pay off all of its debt and were to become debt free, that means there's no more treasuries, guys. That's a financial world that is completely foreign to anything we've known for the last 200 years. And so that would create its own set of problems, and that nobody's ever really considered. We got a glimpse of it in the late 90s, early 2000s. I don't remember exactly when it was, but right now it was late 90s. But that's you don't want to pay off the debt. You don't have to pay off the debt, and you shouldn't pay off the debt if you're the United States. Where it is not Scott Ladner's household, where at some point I do have to pay off my debts. The country does not. And if you understand that and you sort of take that to heart and you think through some of the consequences and some of the logic train associated with that, you'll come away with the conclusion that we do need to be able to service our debt. Like we need to make good on the bonds that are coming, bonds and bills that are coming due. That those have to mature at par, and we got to pay obviously interest on these things. Like you do have to service it. I'm not saying you can ignore it. Like you got to service it, and you got to credibly service it. and that is like we're currently doing that. Like this, these are, this number is starting to go the right way again in terms of interest payments with respect to tax receipts. And the reason why it's going the right way is because the economy is growing really quickly. And so, like we're kind of running a horse race between nominal economic growth and net interest on net interest rate on the U.S. debt. And if you're growing faster than that net interest rate, you're able to service the debt ad infinitum, forever and ever, amen. It'll be fine. So but again, just like close this little section with the plea: do not think about the United States finances like your households or like a financial plan. It is not like that at all. You got to understand it differently and understand that there would be consequences that are really kind of weird if the U.S. were ever to actually pay off its debt, which it never will and never should.
Yep. All right. Nope. I think that's a great point to end on when it comes to the economy. Now let's shift over to markets, because what we've seen, over the last couple months at this point, when it comes to some of the earnings reports, profitability has been nothing short of just amazing. So this is a chart, Scott, we're looking at, right? That's looking at profitability. And I think what you see, so this is the All Country World Index. I mean, you're reporting levels of profitability that we have not seen when it comes to the markets outside of, recessionary period recoveries, right? You look at 2020, right? We were higher at that point. You look at 2008, right? Profitability was higher, both in absolute terms and as a percentage terms at that point. Outside of that, you're looking at a period where earnings growth is really, really strong, which I think, Scott, is super interesting as we start to look at, okay, so then what is leading the return that we're seeing when it comes to markets? And I think this slide is probably going to be surprising to a number of folks because it's probably not what they have in their heads.
No, it's not. I mean, look, people think this, the market so far this year is having a nice year. And people think that, valuations are too high and all this. Valuations come in, like valuations are down. PEs are down this year. And they're down, especially in the tech space. And so like that's, this is a fundamentally led market right now. This is a market that is trading on fundamentals. It is a market that's actually trading behind fundamentals. Like we should be higher than we are right now based on the fundamentals. And we'll go through some of these in the next couple of charts. But yeah, again, I just want to make sure people understand that the market's up less than earnings so far this year. I'll just leave it there.
Yeah, that's definitely wild to think about. And Scott, I think kind of we'll maybe really dive in. Like, this is not just a tech story necessarily, right? This is, if you start to look at like some of the income that we're seeing and the profitability that we're seeing, like it's starting to broaden out, which we talked about, at this point 6 months ago. Like that's an important part of this, this run continuing as we head into the back half of this year and into next year.
Yeah, and look, and this is what we want to see. I mean, for those of you that listen to our sort of like the kind of our outlook for the coming year, like at the end of last year, we were kind of calling for this broadening out trade, and that was starting to play through in the first quarter, and then we got this stupid war or whatever, but and that kind of knocked things off kilter for a little bit. But look, as we saw earlier, the war's essentially over, and we are coming to this place now where you're getting earnings revisions outside of the top 10, outside of the sort of the Mag 7, outside of the big boys in the market. You're starting to see it come through in small caps. You're starting to see it come through in the sort of the other 493 or 490 like that. We want to see this this sort of earnings the earnings results that we've seen out of the top of the market like sort of filter through and sort of come through in the rest of the market. And we are starting to see the nascent signs of that reemerging again finally after sort of a 3-month hiatus due to the war and some of the commodity concerns around that.
Awesome. Scott, we've talked a little bit about kind of the productivity gains and what that has meant for earnings. I think this chart is super interesting. It's really I would say probably an oversimplified way to look at productivity. It's just measuring top line revenue by the number of employees. And what's super interesting here is if you look at going back 20 years worth of data from 2006 to the end of 2023, right, you saw a 30% increase in that ratio. So, an annualized growth rate of about 1.5%, if you look at it that way, in terms of productivity gains, right? In the last 2 years, so this brings us back to some of that AI conversation. The last 2 years, you've seen a 30% increase. that just paints the picture of, what profit or productivity has seen from a gain standpoint in the last couple of years, which then, Scott, this translates to some of the profits we're seeing. Is if you start to look at what has that done over the last handful of years, like you're seeing that jump as well, right?
Yeah, profit. This is profits relative to the size of the economy, profits relative to GDP, and part of the reason why I put this chart in here was to give a sort of a history lesson a little bit, and like give a little perspective, because I was not around in 1948, and my dad was, but I wasn't, and I don't know what that picture looked like, but it looks like this. Like profits, corporate. It's a good time to be a corporation. This is indicative of a very healthy corporate culture, a very healthy sort of corporate America. Seeing profits like this relative to GDP is a good sign. This is obviously strong for equity markets, strong for corporate bond markets. Look, I want to just give a little bit of perspective as to how good things are for corporate America relative to the last 70 years or whatever.
Yeah. Well, and it doesn't matter, right? If we're looking at it relative to GDP, or if this next slide, like we're looking at it on a margin basis, again, this data goes back 75 years. It tells the exact same story, right?
Yeah, and margins are incredibly important. Like the margins tell the story about how much revenue can you take and drop, how much can you drop down to the bottom and profit. Like broadly speaking, and seeing this, seeing these numbers this high is pretty darn strong. Not only from the standpoint of it makes like revenue more valuable to a company, but also like this is a margin of safety too. Yep. This produces a margin of safety in an equity investment or in a company. If you have margins this high, you can take a little bit more downside. It's a little bit safer place to be if margins are this high. You can take the cut. I'm not saying that would be a great thing for stock market in the short term. It certainly wouldn't be. But this not only is a very strong indicator of corporate health, but it's also, I think, a very strong indicator of corporate safety from a balance sheet and sort of business running perspective.
Yeah. Well, and Scott, when you mention margins, I think it's super important to focus on this idea of like margins today relative to where margins were historically should help us kind of get a sense for the valuation conversation, because it's not apples to apples.
No, and look, there's not. You can see the dots on this thing. Like this is not a straight line. This is not a perfect relationship. But directionally, this makes a lot of sense. If a higher profit margin should be able to support a higher PE ratio. If I'm buying a company, I will pay a little bit more for that company if they have better margins. Period. That's all this is trying to get at. And so with margins this high, and if they can sustain this way, you can support a higher price earnings ratio, sort of at the market level. That's what we're trying to get across here. Just the idea of, look, these margins are supportive of richer valuations than we've generally seen in the past. And so to use the past as sort of a valuation guide, we think, if you've ever heard me before on valuations, like it is a really, really bad idea, we think. But this is just one of the reasons, because this is a different operating environment for corporations than we've seen over the last 5, 10, 20, 30, 50 years.
Well, Scott, you mentioned about not using the past to get a sense for where we should be valuation wise. We got a whole slide, and we can unpack maybe why we don't think it makes sense.
Yeah. So, CAPE ratio. Look, Robert Shiller is a brilliant guy. He's got at least one more Nobel Prize than Scott Ladner does. I'm not denigrating the fellow by saying this, but I'm saying that valuation metric is actively harmful. Like it is not doing you any good to look at it at all. The CAPE ratio, just as a reminder, essentially it looks at 10 years worth of data, and let's look at how evaluations were over the last 10 years essentially, and let's see where we are today relative to sort of that idea. I don't care at all about what was happening, what valuations were, what companies were doing in 2017, 2006. It doesn't matter. It's such a different world now. So to use data from 2016, 2017, 2018, the COVID period, to figure out are we properly valued in 2026 and 2027 is just silly. Things are changing too fast, this market is, and these corporations are supported in different types of ways than they were in the past. And so, using something like a CAPE ratio or using valuation metrics to make investment decisions, like do I invest or do I not invest, types of decisions have been an actively harmful thing to do, really for the last 15, 20 years. And so I just caution us to let's not put a whole lot of weight into things like this. It just doesn't give you the signal. It doesn't really tell you anything helpful on a forward-looking basis now, and it hasn't for like we're approaching a generation from when it's been useful.
Yeah. All right. So Scott, we've got a couple slides left, and I think this will be a good place to end it before we hit on some questions. So if we get the question a lot around, hey, is this another tech bubble? Right. And I think this brings us back to the conversation of, earnings, profitability, and tying that to share price movement. I think what we saw in the late 90s, early 2000s was you saw this disconnect between the two. That's what this chart is telling us.
Yeah, I mean, look, if you want to look at a picture of a bubble, this is a picture of a bubble. Now, look, that's easy to say in hindsight. We know it was. But the yellow line is earnings. The black line is is stock prices. And like you can see, like, hey, earnings really did pretty well in the late 90s. I mean, and we're just looking at tech here. Earnings are up, what was that, 50%? Over a 2 or 3 year period. Like that's really pretty darn good. Problem was the stocks were up 400%. They were a lot more than that. And so you just ended up like directionally it made sense what stock prices are doing, but magnitude wise, we had a little bit of a problem. And that problem got corrected as we all know. And so like that's like this. If you want to see a bubble, like there's something that's disconnected from fundamentals, the stock price disconnected from fundamentals. Like this is the picture that you would see. That is not the picture on the next page, on the next slide.
Yeah, I was going to say that looks night and day different, Scott, than what we see right now when you compare the exact same data sets, right? If you look at earnings relative to stock prices for technology stocks, you could make the argument based on this chart that tech stocks are maybe even a little bit cheap.
Yeah, I mean, and that's what we saw in a couple of slides ago on that table. It's I mean, tech stocks are up less than their earnings so far this year. And not saying like this may turn into a bubble, guys. And if you ever heard me say this almost certainly will turn into a bubble at some point. But this is not the picture of what a bubble looks like. This is what a picture of a fundamentally supported market looks like, a fundamentally supported sector looks like. This is stock prices that are just basically following earnings right now. You're not seeing PEs go up. You're not seeing PEs go. You are seeing PEs go down actually a little bit. But this is not a speculative kind of bubble right now. This is we're just following earnings right now, guys. It's like not that complicated.
Well, and Scott, if we were to put them on top of one another in terms of time periods, if you look at the internet revolution versus kind of the AI revolution, like I think you can continue to make the case that we're still very early innings. One, and Scott, you'll probably expand on this, but two, I think we could probably make the case that the AI revolution may be even more impactful than the internet revolution.
Yeah, I mean, I think AI is a much more impactful technology than the internet was, like 25 years ago. It's far reaching. It's more parts of the economy. It is much more useful. It's much more productivity enhancing. All the things. Yeah. But look, don't look at this chart and think Scott's saying we're going to be up 1,000% in the next few years. Like this is just trying to give a little bit of perspective on if you think that we're far along in this process, we might just not be. We might still be relatively early, and there's still plenty of gains to be had in this space, plenty of gains to be had in equities because we are just following earnings right now, and you guys you've seen the data on margins and corporate profitability and everything else. So I'm not sitting here saying these lines are going to track each other. I'm saying this may have a lot further to go than people currently think. And we have an example in history that that can speak to that. And again, I'll say one more time: this is going to end in a bubble. I can almost promise you this will end in some sort of speculative bubble. But we're just not anywhere close. And investment gains are a great risk management tool, and there are investment gains to be had ahead. And let's go ahead and take them while they're there, and we'll figure out the bubble part when we get to the bubble part. But guys, we aren't there right now.
Yep. No, I think that's a great point and a good place to end, Scott. As you can see, obviously we've got a few takeaways here on the slide. We have had a few questions come in, and Scott, really the one that kind of came in time and time again had to do with the Fed, right? And Chairman Warsh, and what does that mean for interest rates and what are expectations for rates? We talked a little bit about inflation expectations coming down. Does that mean maybe we shouldn't expect rate hikes? Maybe just give folks, 30 seconds or a minute on, the new chair and what that means for rates and our expectations there.
Yeah, look, we think Chairman Warsh is highly credible. The market clearly thinks he's highly credible. You wouldn't see treasuries performing like they are, and tips break evens performing like they are if people thought that he was going to be a lackey to Trump, or he wasn't going to be like tough on inflation. Like he was probably somewhat performative in that opening press conference in terms of like being like overly hawkish and being really kind of saying the word price stability somewhere around 490 times. But it was the right effect, and it was the right move to make, because it's an easier position to back off of than going the other way. And he is, a bit of a hawk on this stuff right now. The deal is probably not going to have to be. Hopefully our view on future inflation is somewhat clear right now. We do think it's going to be coming down, and we just think he's going to end up doing nothing for the rest of the year. And a boring Fed is a good Fed. Like it is not a bad thing to have the Fed do nothing for a while, and that's what we think is going to end up happening. And that should, from where we are sitting today, with about a hike priced in for the rest of the year, as that hike gets sort of taken out of that market expectations, rates should come down modestly, and that will end up being again, another small sort of tailwind for equity prices for the rest of this year. At least that's our thinking right now.
No, super helpful, Scott. And one thing, and for those of you that haven't seen the news, we're really excited to have some additional expertise in-house as we think about the rate side of things, as we think about the fixed income side of things, but more broadly, just an additional set of expertise to bring to the table. We did at Horizon just complete the acquisition of Anfield Capital Management, which adds some expertise to our team, both on the fixed income and equity side of things, that allows us to really dive into some of these conversations. So really excited to see kind of how we are able to implement their views. It's a team of folks that a number of them are former PIMCO employees, manage a handful of different products, a couple bond, fixed income focused products, but like I said, also have some equity expertise as well. So really excited to bring them in. And Scott, I think that'll tie in directly to some of the conversations that we're having around what we were just talking about as we're thinking about rates and fixed income.
More smart people in the room is what we're always after. These folks are really, really smart. They're excellent what they do. They are true pros in the fixed income space, and especially the credit space. And so, we couldn't be happier and more excited to bring them in. And like you said, it's not just the fixed income side. They have some equity and some quant expertise as well, that we're super excited to sort of bring in the fold, learn from them. Hopefully they can learn from us. We can learn from them. We can make each other better and produce even better investment returns for our clients. But we're super pumped, and we're just getting started with them.
Yep. Scott, I won't take any more of your time on this. We did have a couple questions come through on some of the recent IPOs. I would draw your attention and really point you towards some of the pieces that we've published within the last couple of weeks. We have a couple good pieces that we've written, and happy to have those conversations. I would say this in short. The IPO conversation should, over the long term, tie back to exactly what we just talked about as you start to think about earnings, profitability, margins. Like those are things that at the end of the day will be important drivers of fair value, share price, those types of things. So again, if you haven't seen what we've put out on kind of the IPO craze, if you want to call it that, over the last little bit, please make sure you reach out, and we'll make sure to get that out to folks as well. Because that's something, like I said, we've gotten some questions about, but happy to continue that conversation. So without any further ado, we will wrap it up for this afternoon. Really excited to head into the back half of the year. As you've hopefully seen, there's a lot going on from a market standpoint, but we think it's really positioned in a way that we could see some continued growth as we get into the back half of the year. We're excited about that, but also excited to continue the conversation with each and every one of you as we head into the last 6 months of the year. As always, don't hesitate to reach out. Happy to continue the conversation, and really looking forward to seeing many of you over the next couple months. We'll be back as we get into the fourth quarter there in early October. But between now and then, everybody stay safe and have an awesome third quarter.